Hey everyone, thank you for tuning in. This video is part 2 of the 100K portfolio challenge. And what I briefly want to discuss in this video is the initial construction of the portfolio and why I divided the assets the way I did, at least initially. So let's take a look. All right, so as I mentioned in video 1, I was going to divide the assets into two broad categories. One was going to be a box spread, which was going to take half of the 100K. And then the second half I was going to divvy up among various stocks and some deep in the money calls. And there's a real interesting one that came up, by the way, in Palantir, and I will definitely discuss that in a future video. But for now, what I want to talk about is two scenarios that demonstrate a sequence of returns and the risk of sequence of return. And let me home in on it a little bit more. And we're going to use scenario 1, in which a starting bankroll is 100K. And in year 1, we're going to have a market drop of 20%. And subsequent years will have an average return for the market of 10% each year. Now this is a simplification, but it's fine because it perfectly illustrates the point I want to make. So here we go. Year 1, everything's in various stock. The market drops 20%, and that means in year 1, after year 1, you're going to end up with $80,000. So you have a $20,000 loss. You go from 100 to 80, and then subsequent years, as I previously mentioned, we're just going to assume an ARR, an average return of 10%, and we can follow along down this column and see what happens year after year. Now, scenario 2, we also have a starting bankroll of 100,000, but what we're going to do here in this scenario is half of the bankroll is going to go into a box spread, and that box spread is going to yield roughly, in this case, we're going to use 5%. So on half of the portfolio, you're going to earn 5%. 5% of 50,000 is 2,500. Now, on the other half of the portfolio, you also suffer a 20% drop in the market, same as in scenario 1. Now, look at what happens. Oh, and by the way, let me mention in subsequent years, after year 1, we're just going to assume an average market average return of 10% per annum. Anyway, year 1, look at what happens in scenario 2 when half of the money is allocated to a box spread. Scenario 2, you end up with 92,500, which is 12,500 more than scenario 1, in which the money was allocated. All of it was allocated. 100,000 of it was allocated to various stocks. Okay, so because you had half of the money earning 5%, so you got $2,500 on your 50,000, and you lost 20% on the other 50,000, which you ended up with 12,500 more than in scenario 1. And let's look and see what happens after year 10. Now they both started with $100,000, or in each scenario started with $100,000. But when all of it was allocated to stocks, after year 10, you have $188,635. In scenario 1, and the corresponding earn for scenario 2 after year 10, you have 218,000. So almost 30,000 more dollars in 10 years simply by divvying up the initial allocation to a box spread, or let's just assume some equivalent that will earn you close to 5% on half of the portfolio, and half being 50,000. Let's continue. See what happens after year 20. Now, after year 20, in scenario 1, again, scenario 1 has all the money allocated to stocks. You have 489,272, and in scenario 2, after 20 years, you have 565,000. So that's 65 and 11, 76,000, roughly 76,500 more than in scenario A. Now imagine that. That's 20 years. Have an extra 76,000. Why? Because you did this. In year 1, you made sure that half of the money was earning you something, and that something was 5%. Let's continue. I went out 30 years, and in 30 years, in scenario A, you have 1.26 million, and in scenario 1, this is 1.26 million, and in scenario 2, after 30 years, you have 1.467 million. So almost 200,000 more in scenario 2, and the only difference, the 200,000, was a result of this box spread, or this 5% earn on half of the portfolio. So scenario 1, this guy went all in, and on scenario 2, a more conservative route was taken for year 1. The subsequent years were exactly the same in both scenarios. That is definitely something to think about, and it's actually why I allocated the money broad stroke wise the way I did. All right, I hope that was helpful. Thanks for tuning in. Don't forget to like and subscribe, and if you think this video will be of use to someone, send them a link. Catch you guys next time.